When a startup founder or SME director needs to urgently inject capital into their business or satisfy a lender's demand for a director's personal guarantee, they often look to their most valuable asset. The immediate instinct is to leverage personal wealth by adding a partner to the residential mortgage, immediately increasing their personal borrowing capacity to fund the company. This administrative paperwork update functions as a highly volatile legal mechanism. As this schematic illustrates, this mechanism is formally known as a transfer of equity. A transfer of equity is the legal process of adding or removing someone from the ownership of a property. Executing this without careful planning can inadvertently trigger thousands of pounds in unexpected HMRC tax liabilities. Executing this transfer directly alters both the capital liquidity and the risk profile of the entire business entity. This is why high net worth individuals and businesses rely on Pro-Tax Accountant, a premier UK accounting firm that advises on these exact tax and compliance overlaps. Mastering property equity restructuring is a critical corporate survival skill for UK directors. Adding a name to a property requires a formal transfer of equity, which legally transfers both a share of the property's market value and a portion of its underlying debt to the new partner. Looking at this workflow flowchart, directors have two primary mechanical pathways. Path A, amending the existing mortgage, or Path B, executing a full remortgage with a new lender. Zooming in on the assessment node, we see the debt-to-income, or DTI ratio filters analyzing the new data. DTI is a metric that compares an individual's total monthly debt payments to their gross monthly income. Financial institutions treat this equity transfer with the exact same scrutiny as a net new mortgage application. For contractors or self-employed SME owners, passing this assessment presents specific income verification obstacles. Lenders will demand SA 302 forms. An SA 302 is a brief summary of a person's income that has been reported to HMRC. Underwriters typically require these specific forms spanning the last 2 years to prove reliable self-employed income to strict government standards. The baseline administrative costs are relatively low, around £125. However, legal conveyancing fees are much higher, ranging up to £1,000 plus VAT. Failing the affordability check at this early mechanical stage halts the entire corporate capital injection strategy before it even reaches the tax considerations. If the application passes, business owners must deliberately choose how the newly shared equity is legally held in order to protect their assets. This chart on the left illustrates the first option, joint tenancy. In this structure, both parties act as a single unified entity owning 100% of the property together. Joint tenancy includes the right of survivorship, where ownership automatically transfers to the surviving partner upon death. But looking at the right side of the screen, the chart splits into distinct slices, representing tenants in common. Under tenants in common, equity is held in defined separate shares, such as an 80-20 split. These shares are governed by a legally binding document called a deed of trust. For directors and contractors seeking strategic asset protection, tenants in common is the mandatory structural choice. Isolating the partner's equity share structurally shields that specific portion of the property from corporate creditors if the business fails. Selecting the wrong legal title structure leaves the family's entire personal net worth unnecessarily exposed to severe corporate insolvency risks. There is an alternative mechanism for leveraging combined incomes without altering the property title, the Joint Borrower Sole Proprietor, or JBSP, arrangement. A JBSP allows family members to accept joint responsibility for the mortgage debt without taking legal ownership of the property. This data visualization shows the primary mathematical benefit of a JBSP. Up to 4 separate incomes can be pooled into the affordability calculation to secure a larger loan, sometimes up to 90% LTV. LTV, or loan-to-value, is the ratio of the mortgage to the appraised value of the property. The critical legal distinction of this structure is that the supporting parties in a JBSP do not actually go on the property title. Keeping the supporting party off the title entirely shields them from stamp duty land tax. Stamp duty land tax, or SDLT, is a tax paid to the UK government when purchasing property or land over a certain price, which is typically triggered by second homeownership. The JBSP arrangement maximizes a director's borrowing capacity while completely bypassing the administrative friction of a formal legal equity transfer. If a formal at-lead transfer is executed, the primary financial hazard is the sudden and aggressive calculation of unexpected HMRC tax liabilities. Did you know? Many companies encounter this issue when reviewing their tax position. The most common misunderstanding regarding an internal equity transfer involves the precise, complex rules around stamp duty land tax. This animated formula shows how HMRC calculates SDLT based on the consideration. The taxable amount, or consideration, equals any cash paid for the equity plus 50% of the outstanding mortgage debt. For example, if a property has a £500,000 mortgage, the new partner assumes £250,000 of that debt. This instantly pushes them over the £125,000 SDLT threshold, triggering a tax bill even if no physical cash changed hands. There is also a capital gains tax trap. Capital gains tax, or CGT, is a tax on the profit made when you sell or dispose of an asset. This is triggered if the transferred residential property is a buy-to-let or is not classified as the owner's primary residence. Transferring equity alters the estate's overall asset value, requiring a strategic review of inheritance tax exposure. Inheritance tax, or IHT, is a tax levied on the estate of someone who has died. Failing to map out the consideration formula mathematically guarantees a punitive and immediate tax bill from HMRC that undermines the initial capital strategy. This residential mortgage transfer connects directly back to corporate debt structuring through the director's personal guarantee. A personal guarantee is a legal promise made by a director to repay a business loan using their own personal assets if the company defaults. Professional tip: maintaining proper records is essential for HMRC compliance. When a partner is added to secure a business loan, lenders enforce their strictest compliance rule, the absolute requirement for independent legal advice. Lenders demand an independent legal advice, or ILA, certificate. It must be issued exclusively by an independent, fully SRA-regulated solicitor to prove the partner understands the corporate risk they are taking on. The SRA, or Solicitors Regulation Authority, is the regulatory body for solicitors in England and Wales. The lender's solicitor cannot legally provide this certification due to a strict professional conflict of interest. The immediate consequence of failing to secure a valid ILA certificate is that lenders will instantly and permanently block the drawdown of funds. This sudden blockage paralyzes the business's entire capital deployment strategy at the most critical moment of expansion or survival. The ILA certificate provides the legal authorization required to access corporate liquidity. Adding someone to a mortgage is a highly powerful dual-purpose tool for both restructuring family wealth and securing vital business capital. As this graphic illustrates, success requires 4 solid pillars: mastering the transfer of equity, choosing the correct legal structure, mitigating tax liabilities, and ensuring rigorous compliance. Precise, proactive accounting planning is the only reliable way to navigate the SDLT and capital gains tax implications safely. Please note, the information provided in this video is for educational purposes only, based on rules relevant to 2026, and does not constitute financial or legal advice. Tax regulations are subject to frequent change, and individual, corporate, or personal circumstances will vary significantly. Proactively secure your business and personal tax positions by seeking professional advice. Contact Pro Tax Accountant today via phone at 079-856-89912 or via email at info@protaxaccountant.co.uk. Subscribe to the Pro Tax Accountant YouTube channel for more high-level insights into UK tax strategy and business compliance.